Hi, everyone. This is Jason Bjark of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He worked at Casey Research for 14 years as Doug Casey's protege. He wrote amazing articles. I used to love reading his articles as Lewis James. He left in 2018 to start his own company, The Independent Speculator. He travels a lot. He goes to mine sites. He travels all over the global economy looking for risk and reward, good speculations. And he's a very good mining stock analyst. He's had a lot of winners over the years for Casey Research. Lobo Tigre, thank you for joining me again.
Thanks, Jason. Good to be back on the show.
So, Lobo, before we start talking about gold and mining stocks, because I think it's a pretty good time right now with gold prices around 2,300, silver's around 27, it's a little bit below 27 when we're recording this interview on Thursday, April 4th, 2024. I want to get your thoughts on the global economy since you do travel a lot. What are you noticing boots on the ground? How is the global economy doing? How is the real economy doing versus what like the Federal Reserve Bank and the government economic data saying?
Well, the short version is I am still in the hard landing camp. I think the world is in a deepening global recession, and I don't think America will be exempt. I think that labor hoarding post-pandemic and all the fiscal, the stimmy checks and all that have distorted, delayed, prolonged the long and variable lags, if you will. But I still think we're going through the ringer. That's the short version. But to answer your question specifically, there's a lot of wealth to be plundered out there, Jason. And just because things are getting bad, that doesn't mean we're going to have shanty towns like 1933 everywhere overnight. And Europe in particular, there's so much trouble over there. And then yet you drive around countryside, let alone the big cities, and there's so much wealth. It's going to take a long time to plunder all of that down to, it took Argentina 100 years to go from a first world country to a third world basket case and just wipe it all out to where they would actually elect a self-described anarcho-capitalist as president. So the expanded answer is, just because I see the hard landing still being the most likely scenario, that doesn't mean that, the world's about to blow up, head for the bunker in Idaho or anything like that. Who knows? The powers that be could lose control. It could spin out of control. The house of cards could come down, but could is such a dangerous word for investors. I just think it's prudent to batten down the hatches for stormy weather. And you know what? If I'm wrong, it's not like suddenly copper and lithium and oil are going to triple overnight and you'll miss all these other opportunities. So we can get to this various commodities, but I'm just seeing an asymmetrical risk reward outlook right now to answer your question. I'm looking at the world, and the risk of going along with the investment herd right now, the team soft landing morphing into team no landing, I think the risk of going there is very high. Whereas the risk of being cautious and waiting, and let's see some proof in the pudding before we put our money there, is okay. You missed the bottom. That's missing the bottom is much better than jumping in the barrel with everybody else when you go over Niagara Falls.
Do you think we're going to see inflation come in waves like in the 1940s or the 1970s? And it also seems, since you were in Europe, is there a lot of flight capital coming from Europe and China, emerging markets, into U.S. capital markets? Are you seeing that when you went and did site visits?
Well, I can't answer that. No, site visits in Europe, I could go talk to my pals, the Swiss bankers and people like that, but they're not going to have that level of detail on where the capital is going. I don't have secret sources in the World Bank or something to give you a satisfactory answer to that. So I just have to say I don't know. I'm a rock kicker and stock picker, not an international money flow guy. But my sense is that, they're not quite as ethnocentric as Americans are, but the prices in the U.S., they lead, even if everybody wants to pretend that the world can do without the United States. We're still the 800-pound gorilla in the space, and what happens in U.S. markets is profoundly important in all European markets and China as well. So there is no independence out there. And I think that's about as far as I can go down there. But I guess the other thing I would say is, even though, as I say, there's a lot of wealth to be plundered, so it's not like we're on the edge of shanty towns on the Champs-Elysees. Well, besides the immigrant ones that are already there, but you know what I mean. There is significant worry, and I don't think it's just central banks buying gold these days. I think there are a lot of high net worth individuals who are starting to get that idea of, you know what, the world looks a bit dicey. Maybe hedging my bets with a little bit of safe haven, real, physical safe haven that I can hold in my hands. Maybe that's not such a bad idea.
And gold prices have rallied a lot since November. It looked like on the charts back then that they could potentially crash way below 1900. Then they've since rallied. A lot of it for a supply and demand perspective. There's been enormous Swiss exports to mainland China and also to India. Did you notice that? Were lots of people talking about, oh, I'm buying physical gold. I'm not buying paper products like GLD. I'm not buying as many NVIDIA or technology stocks. People are starting to take profits in those things and buying more physical gold lately.
I've heard that narrative, but I can't confirm that independently. I can say that here's something I don't know if you've noticed, Jason, but you look at all this record central bank gold buying. Wow, that looks like, great record. But if you look at gold reserves around the world, they're not going up by record amounts. Now, the gold reserve numbers that we get from the IMF, they are broader than just central banks. They include ultranational organizations like the IMF or the World Bank and things like that. So certain central banks have been buying in record amounts, and that makes for net central bank gold buying. But other entities have obviously been liquidating. Where does a large central bank from a big country, where do they get all that gold? They're not going to go to your junior miner and say, hey, we'll buy all your output. So I think a lot of it is coming from other large international players, and maybe some of the flow that you're tracking from Switzerland is some of that. But it's interesting if you look at these numbers. Just look at those two numbers. Look at central bank buying, and then look at gold reserves, which, by the way, are marked to market. So you look at the gold reserves, and yeah, they're curving up, but they're not going like this. They're not going vertical. They're just gently starting to curve up, and it's not by ounce or even by ton. Though, like Doug Casey, I don't like it when people count gold by tons. It's priced in ounces, not tons. So if you look at the reserves, it's by dollar amount or price equivalent. It's mark to market. So if the amount mark to market is going up and the gold dollar exchange ratio, aka price of gold, is going up, well, then the actual amount of physical gold on reserve around the world isn't going up that much, if at all. So I think it's been great for the gold dollar exchange ratio that central banks have added new buying out there. And I think that helped it hold up very well in the face of higher for longer and all those normal headwinds that you would see for gold. But it's not as simple as it might seem. And, it's a dangerous thing for gold bugs to say, well, the central banks are my friends now.
Yeah.
That's the last, group of counterparties that I want to trust as a gold bug.
Yeah, I agree. I think a lot of the central bank buying, I would just call like dollar cost averaging, but the central banks, the foreign governments, especially outside the G7, they don't have a lot of options where to park their foreign exchange reserves and trade surpluses unless like they create like a sovereign wealth fund or something like that. So their options are basically either US treasuries or gold. So those are the two main options. And with the budget deficits blowing out, I mean, the numbers just do not look good. I have the projected budget deficits over 2.8 trillion annualized. Potentially they could be 4 trillion depending upon what the interest rates are, refinancing costs, interest payments on the national debt. I mean, we could be looking at budget deficits over the next 12 months close to 4 trillion.
Well, yeah, I mean, we're already, we're a quarter into the year and we're something like a quarter of a trillion. I forgot the numbers, but the budget deficit. No. What am I saying? It was close to $1 trillion. We're tracking almost $4 trillion in budget deficit in the United States just in the first quarter so far, and it's an election year, right? How much pork spending can we count on this year? Above others. Like H.L. Mencken said, an election is an advanced auction on stolen goods. I think we'll see that in spades this year, right? Back to the gold question, though, just one more thing and this isn't an original me, and other people have been commenting on this, but I think it's quite telling, is the outflows from the ETFs at the same time that gold's going up. I think, that really says something. The buyers are physical, whoever the new buyer is, in addition to the central banks, they're not interested in paper gold. They are looking to hold in their own vaults, in their own sweaty hands, if you will, the physical stuff. I think that's really interesting. And I think it also fits in with why the stocks have been underperforming bullion for so long, because if you're a central bank and you're trying to diversify against the dollar or mitigate against dollar risk, you're not going to buy mining stocks. You're going to buy physical gold. And if you're, an ultranational or a sovereign wealth fund or a very high net worth, family office with old European money, for example, you're not going to take chances on these crappy mining stocks, the best of which are just too volatile for typical Graham dot analysis. You want the real stuff. So it all kind of fits together with the stocks underperforming, with the ETF outflows, and even while the gold dollar exchange ratio hits records. Now, I don't think that goes on forever. I mean, at some point, well, actually today, for the second day in a row, I saw some of the talking heads on Bloomberg, makes me laugh, saying, boy, this is a real head scratcher. Why is gold going up? Like their mainstream economics has no explanation for why gold would be going up. And they're literally shaking their heads. They're too much hairspray on there to literally scratch their heads. I think it would get stuck. They couldn't get their hand back down again. But it's the second day. I got a screenshot. I put it on Twitter of, boy, this is a real head scratcher. Why is gold going up?
Well, they're anti-gold. Their biases are anti-gold,
right,
pro-deflation, so they're anti-inflation, even though historically budget deficits at this size, percentage of GDP, budget deficits of this size, especially with the foreigners not buying U.S. treasuries in the size that they did in the past, like China, Germany, Japan. These are historically.
But the point is that you can't ignore something that goes that vertical that long. So it's penetrating their echo chamber, and that's really interesting. The one thing we never had in 2011 was the common man, if you will, buying into gold. It was still an industry thing. It was gold bugs who were chasing gold in the gold stocks. In the 70s, your shoeshine boy would tell you about hearing about gold, and your bartender would talk about the ounce of gold they might have bought. I know, because I was the shoeshine boy, and I didn't have enough money for gold. I was buying Morgan dollars, silver. But I remember that I participated in that, and that was never present in the last big gold rally. And I'm not saying this is it, today proves that we're off to the races. But if the gold narrative is now starting to penetrate the echo chamber of the mainstream that doesn't want to hear it, I'm not listening. At some point, you can't ignore reality for too long. So it'll be interesting to see what happens next.
So this dislocation you talked about between the gold stocks and the gold price, I think it will change over the next couple quarters. I think it will come from the mining analysts at these banks as they revalue their cash flow projections and raise share price targets. And then the institutional investors will start to notice these earnings beats, top and bottom line beats, increased free cash flow. So it's not going to play out in a couple weeks or even a month or two. It's going to take a couple quarters for the analysts covering these companies to say, you know what, these mining companies, their cash flow projections at 2,300 gold versus 18 or 1,900 gold, they're making enormous free cash flow increases here.
It'll be interesting to see how many of them are brave enough to get ahead of the curve on it. Because you just look at Q1, just finished, averaging over 21. No, I'm not over 2,100 because that came. But, the average gold price well above $2,000 an ounce in Q1 of this year. And, the company, even the mediocre ones from just as recently as Q4 23, they're going to be doing so much better. So I could see some analysts, the braver ones trying to get ahead of the curve there. But we've also seen cost blowouts. So the smarter ones will probably want to see the proof in the pudding. Let's see if these companies deliver or if they don't, blow it all. But if they do, if the companies are disciplined, and by the way, Capex goes into all-in sustaining cost. So this is a case where we want to look separately at cash cost and all-in sustaining cost, because if gold's going like this and you have projects that you can put into production to capitalize on that, then it actually makes sense to divert more of your free cash flow into taking advantage, making hay while the sun is shining. So I would not penalize a company if their free cash flow drops, or maybe even the bottom line doesn't do as well as you might think, if it's investing in future growth. But if it's just failing to control costs, that would be very bad. If the gold companies fumble it again, this would be so disappointing. And I can't say that they've got a great track record of delivering. Rick Rule likes to point out that in the big run up from 2004 to 2011, the free cash flow per share of the big producers decreased over a period of time that gold increased sevenfold. He likes to say that took real talent to achieve results like that. So given that kind of track record, I think it makes sense for analysts to be cautious and then say, okay, show me. But that show me, we could see that starting in the next earnings season.
Or they could just buy royalty companies like Franco-Nevada at 119 with all the bad news from Kobe, Panama priced in. I mean, you don't have to worry about those costs rising. So yeah, there's individual assets, but the overall business, you don't have to worry about the cost of the mining company. You don't have to worry about what just happened to Argonaut Gold, where it looked like they were going to build this Mangino mine up in Canada. And then all of a sudden the costs are way higher than expected. You have similar problems to 2011, the last gold bull run, where the costs were rising faster than the metals price. And then all of a sudden they ended up having to sell the mine for pennies on the dollar to the neighbor next door, Alamos Gold. I mean, that's like worst case scenario.
Yeah, Alamos got a real deal there. But so the royalties are clearly a safer way to play. Like if you can't afford to lose your nest egg and you're really risk averse, but you're a gold bull, then just buy the ETFs or buy more physical. If you're super risk averse, if you're willing to tolerate some risk, but you're not really looking for hockey sticks, you just want to have a little bit more leverage to gold, then what you're talking about, the royalty plays, that makes perfect sense. It's the best combination of leverage to the upside with significantly reduced downside risk. Even in, well, let's put it this way: the example that you brought up was catastrophic for the operator, but it was a bump in the road that the royalty company is clearly able to roll by, though they did get punished. But I think that substantiates the point. This is a lower risk way to go, and then you go down the food chain, right? If you want to try to bet on companies getting better, increasing their margins, then you want to go with the producers. I'm not a big fan of the mid tiers unless they're takeover candidates, and then down into the junior space, then that's where you can get your hockey sticks on discoveries or surprising economics. There's a known discovery, but people are skeptical of its value, and a company does a credible economic study on it that shows a much more higher net present value and higher internal rate of return than expected. That's the sort of thing that can create a sudden value delivery for shareholders. And I forgot the question now, Jason, but the one thing I would throw in here, since we're talking about it, is the better stocks. Yes, they're moving. You can't have something like a $2,300 number like that without the gold stocks that actually have any gold or projects that could go into production. They're moving, but most of them are still relatively on sale. There are like really excellent miners out there, consistently profitable miners that are not anywhere near record highs, despite gold being at a record highs. And there are a lot of the juniors that have projects of real merit. They're still in the doghouse. So I think it's a terrific circumstance when you can look at the commodities clearly taking off. That's not a promise that it's going to go to the moon straight from here, but just look at it, and then look at the gold stocks. And there's a divergence there that, to me, is I think one of the better buying opportunities I've seen in my career.
Do you think we're going to see a lot more mergers and acquisitions where like a producer, mid-tier, or one of the seniors says that like some of these juniors are selling, their shares are down 90%. They have positive news on some of the drill program. And then the market hasn't recognized it. We're going to go do a takeover here because there's value, because the market hasn't recognized the value, and we're going to go buy assets for pennies on the dollar. Is the market going to work through that over the next 6 to 12 months?
I think so, but I must say that this is one that I've been expecting for years. It was overdue before COVID. There hadn't been that much M&A, and prices had come up. We came off of, like, what was it, 1,400 well before COVID. So prices were coming up, and it seemed like it was time for M&A. And so I was saying, the M&A wave is coming. And then the COVID lockdowns hit, and you couldn't travel and do due diligence. And it was one of the worst M&A years in my memory. after during the lockdowns. And then, okay, so then the lockdowns were done. So now the M&A is going to happen, right? We're back in business, but it's been paltry ever since. This year seems to have started with some more fireworks. Maybe this is the year it finally is. But at some point it has to happen. Like these mergers, Newmont buying Newcrest, things like that. These mergers at the top, they don't create more production. You're merging existing production, and okay, now the new company can boast a larger production profile. But they didn't build it. They didn't discover it. They're just shuffling the deck chairs around. I don't want to say on the Titanic because it's not going down.
Yeah.
But it's more of a shell game here, moving the parts around. They didn't build anything new. So I do think, and ultimately, mining is an extractive industry. Every ounce you pull out of the ground, or every pound you pull out of the ground, is one less that you have, one step closer to death, if you don't discover more or buy more. And discovery is difficult. So I think it's standard operating procedure for the majors to let the juniors blow their brains out exploring. And then when they make something that's a significant discovery, well, then we can step in and buy it. So yeah, I do expect it. I'm just being a little cautious about saying, yeah, Jason, this is the year to bet, double down on all your takeover targets, because I have to say, I have felt this way for some time.
It seems that a lot of the seniors are being more selective. So Barrick Gold, the CEO, said they're going to spend more money on brownfields exploration around the current properties. He said they're going to spend a lot more money on exploration drilling for step-out drilling around what they already have, rather than going out and buying stuff. But then you do see them being selective with Great Bear royalty. So that didn't even have a pre-feasibility study on it. And there was what Kinross...
Right, or just look at the properties Newmont's spinning out. They buy Newcrest. And you get things like Valley of the Kings up there, Bruce Jack, and it's interesting to see what they're keeping, and what they're planning to spin out. So what the definition is, the bar is for what counts as, high, big enough and high enough margin for Newmont.
Well, their costs are going up, right? So Newmont's not a low cost producer. Wasn't their cost like last quarter was $1,500?
Right. So they need to hold on to the best of the best. But what this says, though, is that the bar for your takeovers is much higher. I just saw a feasibility study out today. I don't remember which company it was, but it was high profile. People were expecting this for some time, and the IRR was only 19%. Now, 19% is good enough. If it's over 15, you can usually get bank financing for something that 15 is the rule of thumb, is a minimum for mine finance. And so 19, that's not bad, but it's not really robust. It's not super juicy. It's not the sort of thing that I see prompting an immediate takeover. So, but on the other part, not all takeovers are majors. And there are certainly mid-tiers that can take some of these assets that the Newmonts and Barricks of the world don't want and do really well with them. So there's potential there. And I would just caution people about assuming that their favorite junior is going to be a takeover. Even if it crosses that magical 5 million ounce line, that doesn't necessarily make it something that a major would want to buy. You probably have to do a lot of de-risking and show compelling economics, district scale, not just a word in the PowerPoint, but you'd actually have to show, like drill test and show district potential to really interest a larger player. And so the final word on the M&A front, beware of keep the lights on type mergers. Occasionally, if you got a company that has a really great but misunderstood project, and you have another company that has cash, but they don't have a flagship, put those two together, and maybe that story can do better going forward. But more often than not, mergers of juniors are just keeping the lights on. They don't add value. They often don't end well.
Yeah, I would agree. And the buyout premium, a lot of the times, is not what's expected. I mean, sometimes with these mergers and acquisitions, some of these companies, they do enormous share dilution, then a reverse stock split. Some of these juniors do that all the time to survive. You were just up in PDAC in Toronto. Are a lot of these juniors starting to get private placements, say $5, $10, $15 million for drill programs? Are we starting to see that again?
No, not yet. At least not at PDAC. People were kind of depressed about the money. It was still seen as a tight market for finance. But this is an interesting thing too. I see this to the independent speculator out there. I see a market like this is really telling, because say a Lundin company, they're not going to have trouble raising funds. And it's not just them. Other companies out there that have projects that are either of genuine merit or at least really exciting, they're still able to raise money. There are companies out there that can raise money even in what is technically described as a crappy market. So that helps. If there's thousands of these companies out there, how do you know which ones are any good? Well, the ones that can raise money in a crappy market, that's at least narrowing the field. I'm not guaranteeing that everyone that can raise money in a crappy market is a great company, but it sure tells you that there's a large pool of money out there that thinks that this company is good. It makes it worth more of your attention.
The smarter moves I'm seeing, and probably in hindsight, Argonaut Gold probably should have done this, was find a joint venture partner. I know you've said that that's equity dilution. They're only going to own 50% of the project. I'm sure the management team at Argonaut Gold wishes that they had a 50% joint venture partner with a larger miner, so they didn't have to sell the entire mine, Mangino, for pennies on the dollar. We're seeing that now.
Jason, I think you're confusing me with my evil twin. I love the prospect generator business model. And people say, yeah, well, you're giving away 70% of your project but if you get 30% of a Newmont-sized project or a Barrick-sized project or heck, even or an Agnico or whatever, that's fantastic. If you got a carried interest, 30% of a world-class mine from your that's a win. And you're going to get dilution one way or the other. If you say, no, I'm going to hold 100%, and you manage somehow through thick and thin to raise money and build the mine and stuff like that, the banksters are going to end up with half of it anyway for giving you the money. There's dilution one way or the other, even if you nominally own 100% of the project. So it's just a matter of math. If you can early on, I love the prospect generator business model because those are the highest risk dollars. And if you can get other people's money to cover that really high risk drilling, I think that's fantastic.
I was sorry to interrupt you. I was more referring to where, for example, a case study with Goldfields. So Goldfields is funding half of the Windfall project in Quebec, and that mine's under construction now. So Osisko Mining and Goldfields are splitting the Windfall mine up there in Quebec, and then Osisko Mining went and they invested in the junior next door Bonterra. And so they're doing a 35, they own 70% now of the 35,000 meter drill program. They own 70% interest to buy the land and potential mines.
Yeah, I can't. I'm not a real big fan of that. I normally avoid doing company specific analysis, outside of my paid publications. But I will say that I thought the Osisko Goldfield deals made sense. Wasn't a fan of the Bonterra deal, and I get if they've got an exploration team and Goldfields is going to come in and take over a lot. Maybe they need to find something else to do, but the Osisko has plenty of opportunities. And okay, this next story. Nah, moving right along. Next question.
Okay. I was more about building the mine though, the 50-50 deal, because that was my point. You said prospect generators, yes. But I was about a larger miner where they're splitting it. So Osisko Mining decided, hey, if we own 100% of the mine here and the project is not on time and on budget, we could lose the mine or go bankrupt and then have to sell it for pennies. So they smartly ahead of time decided, well, we're going to keep 50% and we're going to let Goldfields spend most of the money and put their balance sheet at risk.
Right. Yeah. That's what I'm saying. Even if they had 100%, but they had to issue equity to raise funds to build the mine, then all those new the company would still have 100% of the project, but the shareholders before the raise would be diluted 50% or more because of all the new shareholders buying equity. Or if a bank comes in it's dilution one way or the other. So I think we're in agreement.
Yeah, I mean, with mining, there's no way to avoid dilution with a lot of these miners. Unfortunately, it just seems they figure out all the tricks. I mean, you've been in this longer than I have. You've seen how many juniors do insane amounts of share dilution, reverse stock splits. I've seen it with silver miners, share dilution, reverse stock splits. It's insane.
Yeah, the only exception is not in the junior space. It's the majors. If you're a really big company and you have even a large project, if you have a big treasury, some of these guys have $1 billion or more in the bank. And so if they have $1 billion Capex, they could just pay for it out of cash. No finance charge, no debt, no issuing new capital, just pay for it. So that doesn't happen a lot. Even the majors will sometimes go ahead and finance part of a large project because they're very large projects. But that's the only case in which there's no dilution. But then it's one asset amongst many in a larger company, so it tends not to move the dial that much.
Yeah, I agree. They're diversifying. So you look at what happened with Canadian Malartic, how it was split between Yamana Gold and I think what Agnico Eagle or one of the other companies. It was split 50-50. And now in Nevada with the Cortez complex, I think Barrick Gold and Newmont are splitting it 50-50. So it's exactly what you're talking about.
Live and learn.
What's your opinion on the copper price then? So for more gold supply or silver supply, are we going to have a much higher copper price in the next 5 or 10 years then?
Well, impact on the monetary metal separately. Copper is interesting that it's been moving up. Now, there's people that are talking about this as another indication of the economy getting better. You know, Dr. Copper with the PhD in economics and or as just another sign of inflation. I don't really think it's either. I think it's China. There have been some improved numbers out of China. I don't think China is about to necessarily take off to, vertically again. And I don't think Beijing wants the Chinese economy to overheat again. That's why it's been struggling to get up off the floor so much. It's because Beijing hasn't just opened the money floodgates. But it does seem like there is some improvement now. And that would make sense to show up in copper. My concern, though, is as we started earlier on in this conversation, is I do still think that the world is in a deepening global recession. So China may be picking itself just on time for Europe to stop ordering stuff from China and for the US to stop ordering, cheap stuff to fill up their Walmarts from China, right? So, it's helping copper now, but I don't think that's enough to overcome a global recession. If I'm right, if I'm wrong, I'm wrong. There'll be time to make money in this space. But if I'm right, I think this copper rally fizzles out. I think copper stocks go much lower. And if the U.S. goes into undeniable recession to where the talking heads on Bloomberg and Yahoo Finance and all these places they're talking recession, then I think spot copper takes it on the chin. I think the mining stocks go down significantly. And then I think that's the buying opportunity. I think with or without electric cars, demand for copper going forward is pretty much baked in the cake. And I don't see the supply there to catch up. So I'm very, very bullish on copper. I'm just reluctant to chase this rally now ahead of what I see as a worsening economic situation.
And we have to see a higher copper price at $5 or $6 a pound before we see the larger copper producers like Glencore and others bring a lot of new supply online. I mean, the CEO of Glencore in the last conference call, he was talking about we're not bringing any new major copper supply online until prices are significantly higher. And they say
I saw that. Yeah. And then never mind. And then, so if you throw in the electrification story, not just the EVs, but the windmills and the solar panels and all the copper that needs to hook all these things up and the greater use of electricity, not just the data centers and the AI phenomenon, but it's not just cars. Apple now is talking about a new Apple robot, and whether they do that or not, I forget who's the one that's already partnered with.
Well, I haven't been following the robots, but I do know the data center. So I don't know if you've seen any of the new articles that have come out from like the Washington Post.
All this stuff is going to use a lot more energy, and it's going to need to be hooked up to the grid, and that's copper. You don't want aluminum wiring in your house. We've already been there, done that, and it tends to cause house fires. So I'm just very bullish, even without the electric cars. And then with the electric cars, the demand just goes nutso. And okay, there are large known copper deposits in the world that have stayed in the ground for decades. We know they're there, but they're just marginal to your point, anywhere near current copper prices. You start seeing sustained $6 copper, and suddenly we might be able to do something about supply, but not where we're at now.
Yeah, I agree. And then that also means unless there's new copper mines coming online, there's going to be less gold and silver supply because the majority of, I think, annual silver supply is byproduct. So it's byproduct from base metal mines, mostly copper. So
That's certainly true for silver. I don't think it's necessarily true for gold, but it is true for silver. And if you combine lead and zinc, more silver comes from that source than copper. But if you look at the metals separately, copper, I understand, is the largest single source. But And that impacts silver more. There's this scenario here where there's nervousness in economy, there's safe haven demand, for gold and silver as monetary metals. But that same nervousness, if I'm right about the economic outlook, could cause the copper miners and other industrial metals miners to pull back production. So that would cut supply of silver at the same time that safe haven demand is pushing it up. And that crossing of the lines there can make for spectacular silver rallies. It's different from gold, and because gold is not consumed the way silver is. And mine supply is just secondary. It's not the major determinant. Mine supply has never been a major driver for the gold dollar exchange ratio.
Yeah, I think the annual mine supply for gold is only around 2,500 tons per year. So stocks to flow, it's not a huge number, but the mine supply is actually it's spoken for. So you have China and other countries, the gold that's available above ground, it doesn't move hands super quickly. A lot of it's religious items or artifacts or in strong hands. So a lot of the mine supply is spoken for with like investor demand or into physical ETFs.
Like on the retail level, that's right. But on the international scale, like we were just talking about earlier, where are the central banks buying all this gold? They're not going to Newmont and saying, "Hey, Newmont, sell me your gold." They're buying it already refined from other players on the scene. So, we like to say that there's something like 97% of all the gold ever mined in all of history is still in one vault or another in refined form, ready to come to the market. So there's so much gold out there that even if we stop mining now for the next 10 years, it wouldn't really change the supply and demand balance that much. It would take like decades of underinvestment in the mining for it to start to actually pinch.
So do you see a scenario where the cost to build new mines, permitting, where the cost is going to fall to build new mines and permitting is going to be accelerated or fast tracked? Because I'm seeing the opposite with a lot of the numbers coming out.
No. I mean, somewhat separately. If we get desperate enough because we're all going to die in 12 years from global warming, climate change now, 12 years was last year, the year before. So if we're all going to die in 10 years, then maybe the powers that be get desperate enough to start expediting permitting projects in the Western world. Something like Operation Warp Speed, because now it's only 8 years. Oh no, now we're all going to die in 6 years, right? So something like that could expedite the permitting, but I don't think it'll get the mine builds any cheaper. In fact, we're seeing that now. The Biden administration is subsidizing, is lending money. Like their idea of helping to incent production is not to make it cheaper, not to get the government out of the way, not to reduce regulations, not to make life easier for miners. It's to give them more money, right? To step in with.
And why not? Subsidies. It's not their money. It's printed.
That's right. I think of it as like the Doritos, the financial Doritos of the world. Use all you want. We'll just print more. Remember the Doritos commercial back in the day? Eat all you want. We'll just make more.
It would be amazing if you could eat that and not gain any calories. But
yeah, but no, if there's a price to pay, the piper must be paid, and this will be true with these subsidies as well. But you hear what I'm saying? Like the whole mentality of the powers that be it wasn't like Trump when we had to come up with vaccines suddenly, and his idea was to get the government out of the way. Operation Warp Speed was not, let's create a new government bureaucracy or a new commission from Congress to study the problem. No, Operation Warp Speed was pharmaceutical companies, let's get out of the way. What do you need to get this job done faster? Right. So that was a completely different approach from what we're seeing under the current administration. And I'm not a Republican. I'm not just trying to blow Trump's horn here. But it's a fact. The approach right now is completely different. It's not how can we reduce regulations? How can we streamline the permitting process? None of that. It's here's some more money.
And I just see Capex, a lot of these miners that have a feasibility study from 12, 18, 24 months ago, they're redoing their feasibility study. Input costs are still rising across the board, a lot of emerging markets, and cost of capital is higher. So I do not see the cost to build a new mine coming down enormously anytime soon.
No, I would absolutely agree.
So I want to transition now to uranium. So the uranium spot price has come down a little bit, still at 89. I would argue that's a pretty good price. Are we going to see a lot of new uranium mines restart in the next year or two, in your opinion?
We're already seeing that. when we for years have been having a moving goalpost of what that incentive price to get uranium miners or uranium developers to start building mines or bringing mines out of mothballs. And that's already happening. The US producers in particular, there are several, I won't name names, but everybody knows who they are, right? They're dusting those mines off. They're bringing them back online now. The lower cost development projects in the world, those are being built now. That's happening right now. There's one that's supposed to be shipping yellow cake already, and we'll see if they declare commercial production. I'm not sure they have yet, but this is happening already. So that tells us we've already reached the incentive price, at least for the better projects and companies out there. And they started last year already. So they didn't start when uranium was at 100. They started when uranium was ramping up through 70 or 80, which is where we had gotten to with the incentive price. So now it's corrected, which, by the way, I did warn people was likely to happen. And I got a lot of hate for that.
Well, you had a lot of hedge funds pile into uranium spot prices. So they were coming up with all types of weird trades to try to leverage up. And Cameco was just like it seemed like almost every money manager or hedge fund had gotten onto Cameco when the share price was just soaring. Goldman Sachs just came out with a higher price target. So these are kind of alarm bells for me that the mainstream crowd that chases higher prices is starting to get onto Cameco now. It's time to look for other opportunities in uranium.
Well, that's why we call some of these largest players in any particular commodity, we call it a go-to company. Because when people get excited, the animal spirits take hold, some price is going vertical and making headlines, then people will flock to the biggest, most well-known names in that space. And in uranium, it's not even, it's less diversity than gold, right? If you weren't going to buy Kazatomprom, and after the second invasion of Ukraine by Russia, like who the heck wants to get that close to Russia? Kazakhstan is not Russia; it's a separate country, but it has pretty close ties to Russia. They ship through Russia. It's not entirely crazy to be cautious about Kazatomprom in the current geopolitical climate. So who does that leave? Orono is, it's not, it leaves Cameco, and I'm not recommending Cameco one way or the other. I'm just saying it is a go-to company. Now, does that actually make it overvalued now? It's hard to say because they've changed. They're not just a mining company anymore. That deal with Brookfield and getting vertically integrated, we'll just have to see where that takes that company.
Didn't they also put in a lot of hedges? And the bear market was absolutely painful. I mean, a lot of the uranium miners barely survived that long and painful bear market, but didn't they put in a lot of hedges at a spot price? So now like they're kind of paying for the hedges now because they hedged a lot of their production to survive.
It's not just that. The anger is that they're putting new hedges in. And uranium bulls are like, it's going to the moon. Why would you hedge again? But they're forgetting that long nuclear winter. Like Cameco survived that long nuclear winter, almost literally, if you think of Fukushima as being the proximal cause. They survived when basically everybody else got wiped out. And the ones that didn't get wiped out, they went out of production and went into care and maintenance. So only Cameco really remained outside of, in North America or in the Western world, North America, it was Cameco. And it was because of those hedges. And they didn't know Fukushima was going to happen. They were just conservative in their business approach. And they said, shit happens. So they hedged against possible downside. And now people are mad at them because it's not just that they have these old hedges. Most of those are done. They're putting new hedges in. And uranium bulls are pulling their hair out. What are you doing that for? Right. And I've seen it at least on social media.
Well, you can't win with some people.
Feelings on this are vehement. What are you doing, Cameco?
You can't win with some people.
Cameco's doing what it did to survive before. I don't blame management at all. Now, I'm not saying I would put hedges on if it was my mining company. I'm just saying I completely understand why Cameco would do this. This saved the company before. What if there's another Fukushima or heaven forbid, another Chernobyl, right? Everybody else gets wiped out. The nuclear power plants, though, still need fuel, and Cameco has hedges in. This could, in a year, if there's another nuclear accident, this could save Cameco again the same way it did last time. So all these people pouring hate on Cameco on this basis, I just think that's wrongheaded.
Well, you can't win
I'm
with some
not
people.
recommending the company, by the
Well,
way. I'm not saying it's cheap. This is not a buy low, sell high opportunity. I'm answering the specific issue.
well, you would say then hedging is insurance in case. So they're buying in case a worst case scenario there so the company can survive because a lot of people forget the shares were around $8 for many, many years. And, when the shares were $8 in 2020, 2021, and I thought uranium could go into a bull market in the near future back during the pandemic. And like we had a lack of power because China had a lot of blackouts and I could see like that nuclear power needed investment. There was tons of articles for years that Cameco was going to go bankrupt and that they weren't going to survive, and uranium would never had a bull market. I mean, that's how bad sentiment was. The shares were just stuck at $8. Management figured out how to keep the company from going bankrupt.
And yet, even as recently as, I don't remember though, I mean, I think pre-COVID, perhaps, I'm not remembering the numbers clearly in my mind, but in fairly recent memory, they were still making money when everybody else was not even dreaming of going back into production because their hedges at $50 plus or minus were way above spot until recently.
Yep, and they were doing hedge fund stuff too. They were buying it in the spot market and then reselling at a contract price, and they were making a spread. So they were making some money without actual mining, which was
Now,
actually
again,
kind of clever.
we're not really going on about Cameco. We're talking business here. And therefore, this would not translate to other companies. The thing about uranium is it is an investment thesis that can almost literally melt down on us. If there is another Chernobyl, uranium will tank, spot uranium will tank. The uranium companies will get hammered on this basis. And I would see Cameco being the only one left standing because of its hedges again. That doesn't happen in gold. Like gold can correct, gold can drop substantially, if it's higher for longer, right? And if the dollar surges again, and if the central banks or other larger players have been propping gold up, if they've had their fill, they've had enough, I could see gold retreating substantially. But it's not going to go down to $50 or something. It's, you know what I'm saying? It
So
doesn't
there's
have
not like a
meltdown.
Fukushima risk or something. So yeah,
Right. There's nothing like that in gold or copper, by the way. They can go down, but they won't fall off cliffs like that. So the
yeah,
so the
I
reward for hedging in this space is much less. Like if there was a gold miner or a gold developer that was putting on hedges in such a big way, like Cameco is doing, that would be a reason for me not to buy that stock. Like my perception of the upside and the risk of downside in gold or copper is completely different from uranium. And I would not be happy with management hedging in those spaces.
Yeah, I agree. I actually had some friends I met through other contacts who were like nuclear engineers and nuclear physicists and stuff like that, working at nuclear power plants. And they told me post Fukushima here in the United States for 5, 6 years. I mean, people were putting their resumes into other stuff as engineers. They thought the industry was dead for years, that it was over.
Yeah, now I will throw one thing in here. I'm not. I think we're running out of time, but I want to stress though that the world has changed so much. I was joking before, but it's not really a joke. There's people out there who really think we're all going to die in 10 years if we don't stop oil now, right? So in that context, even another Fukushima might not derail this nuclear renaissance that we're seeing right now. It might not be enough. I think it would take a Chernobyl scale event, like actual radiation release meltdown, people dying from the radioactive materials released by a meltdown plant. I think it would take something like that to really derail this thesis. I'm not dismissing the tragedy that Fukushima was, but it was the tsunami that killed people, not the nuclear power plant. And yes, it was an emergency. They had to step in and do all kinds of things, but they're engineers. They stepped in and they did what was necessary to solve the emergency. That and frankly, the Zaporizhia plant in Ukraine in the middle of a hot war, not releasing any radiation. I think these things tell you a lot actually about how safe nuclear power has become.
Yeah, there's a lot. There should be multiple backup systems. I mean, Fukushima, there was some corners cut in the construction. If the plant is designed correctly, there's multiple backup systems to protect a leak or a failure.
Well, and now we know, right? I mean, I can't say that I would have done any better. I'm certainly not an engineer, but in hindsight, it certainly seems short-sighted to put the generators that would keep the reactors cool down there close to the high water level where a tsunami could affect them. And it's not like tsunamis are unknown in Japan. I mean, it's a Japanese word for crying out loud.
Yeah,
Right?
they also didn't put concrete over the top of the generators. They were connected on the same power line to the main operator. They didn't put a separate power line. There was a bunch of corners cut. I mean, I spoke to Patrick Cox, who was working at Agora Financial a long time ago, who went and visited the site. But I want to thank you so much for your time today, Lobo. If my listeners want to check out the Independent Speculator, what do you do over there with your newsletters? Do you have a free newsletter? What do you do on your paid newsletters?
All right. Well, thank you for that. I do have a free newsletter, and it's a weekly digest that I put out. And if you sign up, you may or may not like everything I have to say, but it'll show you how I think and work. And the one promise that I make there is that if you do, I will not flood you with this, giant torrent of spam every day. I hate that kind of hyped up marketing. You get one email per week, and that's it. You can unsubscribe anytime if you like. I have two paid letters. The Independent Speculator is, my premier level, where it includes my stock portfolio. What I'm doing with my own money is the central feature, and there are alerts and all kinds of things. But the one thing, since you give me this opportunity, Jason, that I will mention is in between, there's this thing called My Take, which people don't understand because it's really not really a newsletter. It's a database. It is a huge searchable, sortable, slice it, dice it, however you want, database of hundreds, about 800 resource stock evaluations and counting. We take requests, and you can search for, say, commodity silver. I want junior producers, and I don't want a positive recommendation or a positive outlook. And you can sort for just that subset, or you can make it major gold producers, and you can sort by country. So if you're not interested in Bolivia or something, you can rule that out. So this is a very powerful tool that most people just have no idea what it is until they subscribe, and they're like, holy cow, I can't believe there's all this information here for me to deal with. And we update it, continuously. So there's fresh information on hundreds of companies there all the time. And it's a modest fee to check it out.
And you're kind of like the male version of Where is Carmen Sandiego? Because I see on your Twitter or X, and you're posting pictures of site visits, and you're like, "Where am I?" And then you're showing like kind of teases of like your site visits to the.
I do like to play that game with readers, but I have to tell you, Jason, that I'm not going to retire my trusty boots, but I'm going to be doing less traveling because I've expanded the team, and I've trained some guys. They're really great, and I'm kind of painting myself into a corner because I can send them out, and I should send them out. They need, they're great, but they need more experience, and they're closer to, I've got a guy in Canada, so it makes more sense for him to go to Canadian projects. I've got guys in Europe. It makes more sense for them to go to Africa than me. So I'll probably be doing a little less rock kicking than I have in the past because it makes no sense for two analysts to go on one trip. So I just got to be frank with you. You might see less globetrotting on my part, but the team will be doing it. So we're kicking the rocks, proofing the stories firsthand is still very much part of our MO.
And it sounds like you're listening to the conference calls because you were telling me about stuff with Glencore and other stuff. So it's a lot of interesting stuff in commodities. I think it's still underinvested. And I think we're going to pay a price with a lot of these key commodities for cheap energy and electricity, copper, nuclear power, and then gold and silver going forward. There's just been a lack of underinvestment, and I see costs rising going forward to build new projects.
Yep. We're on the same page.
I mean, maybe in the short term, there's like a hard landing, like you say, but then that would be potentially a buying opportunity for some of these. So like if someone's a short-term trader, then you want to keep some cash or a short-term treasury, some liquid in case. But long-term, I think like there's definitely a lack of good projects. There's a lack of supply, and more investment needs to be made in new supply.
So for clarity, right now I'm buying gold stocks and uranium stocks, and that's it. Copper and even lithium, after the recession. Silver is somewhat in between, but even your diehard silver bulls will tell you that silver typically lags gold in a new bull market and then catches up later. So between that and its industrial aspect, it's obviously increased industrial, side. I'm not anti-silver. I can see buying a great silver opportunity if I find one this year, but I'm focused very much on gold and uranium right away. And silver, we'll see how it goes. I mean, today was one of those days where gold was in the red and silver was in the green, which is great for silver, but it tells you that it's not entirely tracking gold as it used to in the past.
There's also a lack of low-cost silver deposits that can come online. I mean, a lot of the silver deposits that were found back in 2010 or 11, and they need 35, 40, $45 an ounce silver, and the Capex is very high. So you're not going to see a lot of new low-cost projects being brought
And
up.
even amongst those that are out there, many of them are in countries that are just, if not already high risk, then visibly going in the wrong direction. So it's hard to find a good silver play and not feel like you're skating on thin ice.
Oh, I totally agree. If you go and look at like most of the primary silver miners and you go and compare what they were producing 7 to 10 years ago, they have like 50% of their revenues now are in gold.
Yeah, the big ones at least, well, I mean, that's why a certain large royalty company dropped silver from its name.
Well, yeah, Wheaton Precious, but Wheaton doesn't mind though. I was talking about like Coeur d'Alene, Hecla. I mean, those guys went and Fortuna, they had to go buy gold mines, and if they didn't own gold mines now, they'd be in financial trouble. But they're minting money with free cash flow. Some of them, at least Fortuna, is on like their.
I don't think Fortuna diversified into gold to diversify out of silver. I think they bought Rox Gold just because it was undervalued and it was obviously a mine in the making, and they thought that with the local team there in Africa that they could do it. So I don't think it was I don't think it was a commodity diversification move. I think it was specifically that company was a great opportunity and it was a good fit for Fortuna.
Interesting, because like I've listened to mining executives talk about how they needed to diversify into gold because the profit margins overall, gold mining is the profit margins are just consistent.
Yeah, and then but it's funny, you listen to the big gold miners and they're talking about diversifying into copper.
Well, I mean, I guess they don't have a choice because I mean, what Freeport-McMoRan, their byproduct, they're actually the second largest gold producer, but it's all gold byproduct. Yeah, let's just wrap up here, Lobo. Thank you so much for your time. I really appreciate it.
Thank you, Jason. Great conversation.